Hey, what's going on, everybody? We're here at the TradeUI team, and we have an awesome series for y'all known as the Market Master Series. In this series, we're going to go over various topics such as understanding trading basics, understanding fundamental analysis, technical analysis, how volume impacts your trade. We're also going to talk about proper risk reward, and lastly, we're going to show you how we put all of this together to find winning positions. So over the course of this series, if you haven't, go ahead and like and subscribe to this channel, and I really hope you get some awesome benefits out of here and become a market master just with how we are over here at the TradeUI team. So let's get into it and let's start the understanding of trading basics. Now, this information, if you've already been in the markets, you might have heard this before, so it's good to go ahead and relearn things sometimes or just hear it again. That way you tend to forget things over time. So this is some good information. So if you've already know the basics of markets and you've been in the stock market already, go ahead and stick around because you might learn something here. So we're going to talk about stock market basics and how it works. The stock market itself is just a division of where people can buy and sell certain equities out there in the market. These equities are associated with companies and they tend to have certain percentage values with them. So each share of a company is a stock, okay? And each company has so many stock in their company, usually in the hundreds of millions of shares. What you can do is buy those shares and claim ownership of a company such as Tesla. You can buy companies such as Apple, Amazon, Google. All of these different companies you can have ownership in, and that is buying a stock. In the world of stock buying, there's a lot of stock buying and selling going on. This is where you buy a stock for a certain price, sell it for hopefully to sell it for a higher price and make a profit. And sometimes you buy a stock and it goes down in value and you may have to sell it for some reason and take a loss. That is how stock trading works. Throughout this series, we're going to show you how to become a better stock trader and understand the basics so you can learn and get into the markets. So what I have in front of me is a graph on TD Ameritrade. This is actually Thinkorswim. I love their platform for analyzing stock. And what this is the stock chart of Tesla over the past year. This is all of 2023. What you'll notice is a stock moves in three directions. Direction one, a stock will move up. Next, a stock will move sideways. And then lastly, a stock will move down. So those are the only three directions a stock can move, and understanding that pattern will give you the opportunity to know when to get in, get out, or see where a stock is potentially going to go. So what does that mean though? When a price of a stock goes up, there's only a limited amount of supply of that stock. It's all the shares that make up that company. It's all the people that own that company. So if a company is popular and it is profiting and it is producing money, the supply will stay limited, but the demand tends to go up, therefore increasing the price or the value of that supply. When it's consolidated or trading sideways, if you look right here, it kind of goes in the sideways pattern. You notice that is where people are either kind of okay with where it's at on price, so they're starting to share their sales, but other people sell their shares, but other people are wanting to get in and buy it because they're thinking, he may be done. He may think that that's valued out there, but I think it has more room to run, so I'm going to buy there. And then more people sell, more people buy, more people sell, and more people buy. So you have roughly the same amount of buyers and sellers, which means that the stock is going to trade in a zone, what we call as a consolidation period. And that is where it's consolidated or trading between two prices. Usually two price points, which we'll look into on the technical indicator side later. Next, you're going to have a price of the stock move downward. So this means that there's too much supply for the current demand of the market, therefore the value of the company is decreasing. Does this mean that the company is unprofitable? No. Does this mean that the company is a bad company? No. This just means at that point in time, there is no demand for that current stock in that company. So there's different things that move the market, earnings reports, how the company's doing, key levels that the stock has risen or lowered to. And there's a lot of factors you can't control, such as how the U.S. government comes into play on this, or how national governments come into play. Maybe some kind of news comes out on the company that it was working with, and they have a large stake in that other company that causes the price to change. So there's a lot of different things that we're going to dig into throughout this series, but this is the first series on understanding the basics. And if you stick with us on these next 5 parts, we're going to show you how to become the best trader you possibly can.